you're pretty deeply kind of oversold levels on money flows. You're down to levels that normally kind of at least form at least a short-term bottom. And again, I'm not talking, again, I want to be really clear. I'm not saying that the markets are getting set up here for a rally off to new highs and you should just be, completely risk on. I think there's a tradable opportunity here because we have so much negative sentiment in the overall market. And again, when people are super negative, very worried about the markets, that's a great setup for the markets to do exactly the opposite of what you think.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week for another weekly market recap featuring my good friend, the well-rested and bottomless portfolio manager, Lance Roberts. How you doing, Lance?
Well, I don't know about well rested, but yeah, we're back in studio.
All right. Well, you're back from your vacation, as we were talking about before we turned the camera on. No good vacation goes unpunished.
Yeah,
You've been digging
that's a
out.
fact.
But we're glad you're back, even though Michael did a great job as your stand-in. I also use the term bottomless because it just seems like the market's just trying to find a bottom here, but just not quite finding one yet. So
I
let's
disagree
talk
with
about
that.
that.
I'll disagree
Or
with that point.
you'll disagree with it?
Yeah.
Okay, good. Because starting about 2 weeks ago or so, there was a lot of talk of, hey, the markets have sold off, but they're very oversold, and a snapback, a little bounce wouldn't be out of control or out of the ordinary. But the market's really just kind of zig and zagged from here. So what's going on? What's driving all this, and what do you expect to happen next?
Well, I mean, as with anything, when you go through a correctional process, which is, again, that's all that's happened here. And again, lots of headlines out lately, and this is a really kind of critical thing that we need to discuss. I guess probably more often than we do, is that human nature is that when something happens, we have to rationalize why it happens. It's interesting. We don't rationalize things when markets are going up. We're like, hey, markets are going up. It's great, blah, blah, blah. But as soon as you have a bit of a correction, then all of a sudden we've got to rationalize, oh, why are stocks correcting? Well, it's because it's recession risk. It's because of this. It's because of that. It's because of this other thing. And, Trump said this. And the simple reality is always the case, is the market is just buyers and sellers. And there are points. And again, when you go back to mid-February, you and I were talking about sentiment is extremely bullish. Everybody's on the same side of the boat. You've got correlations between, all assets pretty much at one. And so at some point you're going to get a correction here. And, that's what's happened. It's just simply that as is always the case, buyers live higher. Sellers live higher, buyers live lower. And so once the people that were buying go, you know what, maybe I need to step out of the market here. Buyers like, yeah, I'll buy from you, but it's going to be 10% lower. And that's what's been going on here, is just simply a repricing of markets. And now we've got extremely negative sentiment. We've got extremely negative positioning on a lot of different fronts. Money flows are starting to turn positive. So, the buyers that are now stepping in are the ones going, hey, you know what, there's some value here, and I'm going to pick those up.
Okay, well, let's get into the data early on this one then, because there's a number of the folks I've talked to again over the past couple of weeks have said, hey, who knows what's going to happen, but my best guesstimate is we're going to see some sort of decent bounce here or short-term recovery because things are oversold. There was a chart that you put out probably about a week ago or so on Twitter that is in a recent article you wrote this week about how hard to expect the market to really roll over from here because retail buyers haven't stopped their buying. In fact, they're
Right.
buying at pretty aggressive levels. But again, the price action's been kind of trapped here. So what is the data telling us right now in terms of the extremity of oversolds and where we are? And one big question when you pull it up is the 200 DMA potentially now acting as resistance versus a floor?
Yeah, the answer to that question is yes, it is. It is. Of course, whenever you violate a moving average of any sort, it initially acts as resistance. So, that's always support and resistance levels. That's why we call them support and resistance. So what was previous support is, once it's broken, it now becomes resistance until it's broken again. And yes, that's just the dynamics of technicals. And so, yes, absolutely. Right now, the 200-day moving average is certainly kind of the key critical kind of first resistance level. Market keeps trying to get above that over the last week, has not been able to do that. But again, when we start looking at kind of the longer term, aspects of the markets, and again, stepping back out just for a moment, every year we talk about this on a regular basis, but in every given year, the markets are going to have a 5 to 10% correction every year. We had an 8.5% correction last year in July and August. We had a 10% correction last summer. Summer before that. So those happen all the time. And, when you're in the middle of it, it feels terrible. And again, we've got to assign all these reasons. 2 summers ago, we had that 10% correction because AI was dead. And, AI was over and the whole valuation.
And the yen carry trade was blowing up and
Yeah. And then in July and August of last year, it was the yen carry trade blow. Oh my gosh, it's over now because the yen carry trade blowing up has gone on. And then immediately after that, markets took off running again. Now, I'm not saying that markets are going to take off running to all-time highs. They certainly could. But when you get extremely oversold conditions, you're going to get buyers stepping into the markets. And that's really what we've seen over the last week. So there's a lot of stuff on this chart. So I'm just going to start at the very top of the chart. We're going to work our way down to the bottom. So the top chart, the top of the chart is a moving average convergence divergence indicator. Everybody knows this as MACD. All that is a measure of momentum. Is there momentum in the market or is there not? Well, currently right now, we have the lowest level of momentum since the October 22 lows. So remember, at the bottom of the correction that we had in 2022, when the markets were down almost 25%, you had momentum as negative now as it was then, and we've only been through a 10% correction. Mm-hmm. So in the next chart, so let's move down to the next chart. Those shaded bands, that's what's called a Fibonacci retracement. And, someday we can spend some time on the mathematics behind Fibonacci and the golden ratio. But if you're really interested in it, just go Google Fibonacci retracement and you'll get all the information you need on it. But it's what's called the golden ratio. And there are certain mathematical percentages that occur during market declines and advances. And so if we measure the market from the October 2022 lows, this entire bull market run from October 22 to now, we have only completed a very normal 23.6% correction, right? So, I mean, this is just a normal correctional process, 10%. Pulled that down. We broke the 200-day moving average. And of course, now again, when you break the 200-day, you get a lot of people coming out and it's like, oh my gosh, we broke the 200-day moving average. That means the bear market's back. You got to be really careful with that. Here is 2 summers ago, we're just talking about that 10% correction we had 2 summers ago, violated the 200-day moving average, and that was your buying opportunity. Moving back into March of 23, during the Silicon Valley Bank blow up, we broke the 200-day moving average. You should have bought that dip. So again, going back historically, just having a violation of the 200-day moving average is not a sell signal. It is certainly a signal of caution, and we certainly need to be aware that we have violated that. But we have to then compare that to the rest of the market dynamics that are going on. Now, I want to be really clear at this point. I'm not saying that this correction cannot turn into a deeper correction. We certainly can. It is certainly possible. You need some catalyst for that, right? You need some event that undermines the confidence of the markets to drive it lower, but that could certainly occur. We could certainly turn a 10% correction into a 20% correction, just like we did back in October of 2022. But remember, back then, the Fed was hiking rates. We had inflation running hot. We had the Ukraine-Russia war breaking out. There were certainly a lot of catalysts that put a lot of uncertainty under the markets in terms of what the most important drivers of markets are, which is forward earnings. So what you need to have a bigger correction right now is something that all of a sudden makes Wall Street go, you know what? I don't think we're going to generate 15% return, 15% earnings growth next year. I think it's going to be 9. If that would occur, that's going to lower the forward earnings and forward operating earnings estimates, which means I have to reprice the market for much lower expected rates of earnings growth. We don't have that. Estimates have come down for the first quarter, but only marginally. So we've only minorly tweaked first quarter's earnings. We're about to start reporting earnings April the 1st. For
All right.
2020,
Sorry to interject on this, but just real quick, you've warned for a good while that forward earnings estimates are unreasonably high.
They are.
And that they're going to have to be marched back. It sounds like you're saying we're starting to see that, but just very little so far. So I just want to make sure you still believe the majority of the walking back lies ahead of us at some point this year.
Yes, but what's important though, Adam, is the speed at which those estimates are walked back, right? So for instance, a good example, the estimates for 2026, year end 2026, they were at $289 a share. That's what we were talking about. That's just way above what the long-term growth trend is. Those have declined now over the last couple of months from 289 to 285. So they've come down by $4. They're still grossly overvalued. That's a very minor tweak to earnings. Now, if over the next 2 years that comes down to 260 or 250, but it's a very slow, gradual process, the markets will adapt for that. What you need to have a much bigger correction in the markets is something that all of a sudden analysts wake up tomorrow morning and they go, it's going to be 240 or 250. I mean, there's a massive drop in estimations, and that's because of some economic event, some type of crisis event, whatever it is. There's clear signs of recession setting in. That's going to cause a massive reversion to earnings very quickly. That's going to cause the market to reprice at a much deeper level. If it's a normal decline in estimates, just aligning with reality, the markets will adapt for that over time. And again, because everybody's always looking forward to like, oh, okay, they brought it down, but I can still get this, right? And so markets will always bid up for estimates in the future. So again, the importance of forward earnings is the most critical driver to the outcomes of markets. Everything else, headline wise, is really kind of just not good stuff to look at. People talking about recession risk and all that. There's no evidence of that in the economic data. We just published an article on that today. Retail sales were good. Employment still strong. Unemployment claims remain low. There's no evidence that there's a recession starting in the economy. But whenever the market declines, that's the first thing people jump to, right?
Yeah.
So,
all right. So we'll talk about the recession risk in your article in a bit. Yeah. But you're basically saying, look, just watch earnings expectations. That's the signal. Everything else is pretty much the noise.
Correct. So again, you take a look at this correction. We're extremely oversold. The 15-day money flow has started to turn positive. That's going to trigger the 20-day money flows to start to turn positive as well. This is real bumpy stuff. You can see it's real jagged. But again, you're starting to see money flows coming into the market, which suggests that we've probably formed at least a short-term bottom. Now, where the rally gets to, whether we can get above the 200-day moving average or get back to the 50-day moving average, that's about all I would expect. I think there's a real possibility that we're in for a consolidative period where markets are going to trade flat to sideways for a bit. But so if you get a rally here, there's a few things to do in your portfolio. I got an email today from a gentleman that's completely on the wrong side of the market. It's been really hurt. And we were trying to kind of work through cleaning up that process. But if you're decline and if you look at your portfolio, the market's down 10% peak to trough. We're down about 8% right now. So if you look at your portfolio and your portfolio is down 15 or 20, you've got way too much risk in your portfolio. So any rally that you get, this is where you want to start trimming back, your risk exposure, lowering your leverage. If you're trading, 2-for-1 leveraged ETFs, stop that. And there's a couple of reasons for that. First of all, any type of leveraged model in a consolidative market, even if the market goes sideways, you're going to lose money because of optionality, right?
Yeah.
So raise some cash, rebalance positions. We just went through our dividend equity growth model and just rebalanced the whole portfolio yesterday, top to bottom. So then there's some reasons for that. We'll get into that in a few minutes, but we're getting set up for a pretty big rotation in the markets. It's just going to be a function of how long till we get there, but that's going to happen. So things that are really grossly overbought and extended, take profits in it. raise some cash. Stuff that's really, really beaten up, that's out of favor. If it's a good quality asset, look to start buying it, because again, the market's going to rotate into those unfavorable sectors from the very favorable sectors.
All right. Is there a factor that's in common with that rotation, like value versus growth, or
Yeah,
small versus big, or what?
yeah, absolutely. So, we show you this all the time. So this is in our Simplivisor platform, but this looks at all the different factors of the market. I think Michael Leibowitz went over some of this with you last week.
He did.
Okay, yeah. So if you take a look at what's really oversold right now, quality factors, mid cap growth, high beta names. That's your mega cap stocks, et cetera. Small caps have been beaten to a pulp as of late. Things that are grossly overbought: gold miners, buyback achievers, developed markets, emerging markets. That rotation constantly occurs. And then you take a look at gold and gold miners, which is in the far right hand quadrant. You can't sustain this very long. The deviations from long-term moving averages are so extreme right now that those are going to pull back. And it's just a function. It could be tomorrow, it could be next week, it could be next month, but you're going to get this rotation from grossly overbought to grossly oversold. So now this is what I'm saying. It doesn't mean, go sell all of your international, go sell all of your gold and your gold miners. That's not what that means at all. It just means that when you go back to your risk management in your portfolio, if gold is 5% of your portfolio and it's now 7, trim it back to 5. And then that way, when the market does rotate, you've already taken some profits out of that, and that will set you up eventually where gold and gold miners will get back to being oversold, and you can buy them cheaper again and increase your position weight. But that's just a function of managing the risk in portfolios. But this is an exercise that you should be doing on a regular basis anyway. And if we take a look, for instance, we look at this a different way. This is just excess returns over time. And you can see that, gold and gold miners down at the bottom, they're extremely deviated over the last 20 days. And they've come up from being laggards in terms of performance 80 days ago. So again, this is that rotation that occurs, right? So they were outperforming, then they were underperforming, and now they're outperforming again. That's that rotation in the markets. And you see this through every different cycle. But now this is the time to start looking at stuff that has good quality, right? We don't want to buy junk. We don't want to buy speculative assets. We don't want to buy those type of things. But, this is the time to start looking at buying companies that have good quality, strong earnings growth, because they're out of favor at the moment because of the narrative in the market. But we're about to go into earnings season where those stocks should start to perform better.
Okay. And it looks like it's actually less of a value rotation, but it's more, kind of the previous darlings, right? From a year ago, right? I mean, the Bag 7 type stocks, right?
Yeah. Your growth stocks, your growth companies are the ones that have been under the most pressure. So those are the ones that, again, when you start looking at, and you and I discussed this previously, but you take a look at, just valuations as a function. This is where, eventually investors are going to start looking for companies that have good, strong, solid growth, can continue to grow relative to the economy, and are trading cheaper in the markets. And we've got a lot of companies in that space, NVIDIA, Meta, Google, all trading a lot cheaper than the actual S&P itself.
Okay. All right. And when you say they're trading cheaper than the S&P themselves, is that on a
relative basis?
PE basis? Pardon me?
Yeah. On a forward earnings basis.
Forward earnings? Okay.
Yeah. So forward earnings basis, NVIDIA trades at 20, and forward PE on the S&P right now is about 22.
Okay. All right. Yeah. That's actually quite notable then, that you can pick up, some of these. Is Google there at 16?
Mm-hmm.
Wow. Okay.
Yeah. And again, these are companies that have really strong earnings growth right now. So they're growing sales, they're growing earnings. So again, that's that's the whole process of investing, right? We want to buy stuff that's out of favor, and unfortunately, what we tend to do as investors is that we do just the opposite. We buy everything that's, oh my gosh, this is going up right now, so
we momentum chase. Yeah.
Right. We buy high, and then we wind up when it corrects. It's like, oh my gosh, I was wrong. I got to sell it low. And,
right.
That's
and that's why I love having you on, where you remind people of your process, and then you show us how you actually act on that process. And it may not necessarily be sexy, But it's the kind of thing, as you always say, this is like football. It's a game of yards, right?
Mhm.
So you're just trying to, as you can, you're just trying to pick up yards, and over time, you'll make forward momentum. Um, so I totally want to say, look, that's the way to win in the long run. And of course, you want to, more often than not, buy low, sell high, not the other way around. Don't momentum chase. Um, there also is a mindset, might be a correct one, might be incorrect one, but a mindset that really drove the Mag 7 over
Mhm.
previous years, which is, hey, when you're in an inflationary environment, you want to own growth. You want to own companies that can grow their earnings faster than the rate of inflation, right? To give you a
Mhm.
positive real return. Is there sort of a similar logic as the economy starts slowing down and you have recession fears, which is, hey, if things are going to start growing less, I want to be in the things that are going to be growing the most to offset that slowdown.
Right. Yes. And so again, we're talking about two different things, right? Which is short term, we've got a really grossly oversold market. The
Yep.
growth stocks are the ones that have taken the brunt of the selling. They're the ones that are most grossly oversold on daily and weekly basis. So those are areas that I want to put some money into potentially right now for a reflexive trade in the markets.
Yep.
Longer term, and again, this is why when you look at our portfolio, we've got a very small weighting to the growth side of the portfolio relative to the whole portfolio. We have a lot of value kind of oriented stuff. Because longer term, if the economy slows down, I want to own value in bonds because those are going to perform the best in a weaker economic environment, slower inflationary growth, higher unemployment. That's where you're going to start seeing yields come down, bond prices go up, and that's kind of what's been happening over the last really the course of this year so far. But also value stocks really starting to outperform. And this is kind of one of the narratives I think that's going to fall apart later this year is the emerging markets and international. It's been really outperforming this year so far. It's
Yep.
been doing great. But again, those economies aren't growing and their relative valuations, the valuations of those companies relative to their own countries are not cheap. They may be cheaper than the US, but they are not cheap relative to their own country. And every year we kind of see this early on where it's, oh, this is the year of small caps, this is the year of international and emerging markets, and it falls apart because they're not growing and the policies that they have in place are going to impede that growth further. So once you start to see that start to kind of that realization come back into reality, I think you see money flow back into the US equity markets because of stronger economic growth and better fiscal and monetary policies.
Let me just put one idea maybe on the other side of that logic in.
Sure.
So several of the folks I've interviewed recently who are international investors, they're pretty excited right now about what's happening in international markets. One, because they've got some good momentum, as you said earlier, but
Right, right.
their reason for being excited now, and particularly markets like Europe and markets like China, um, which have been pretty moribund in the past, few years, is that as the U.S. is now trying to kind of get its fiscal spending under control, or
Mm-hmm.
trying to moderate its fiscal spending, those other countries are now really ramping up their fiscal spending. And so you've always said, fiscal spending
Yeah.
benefits, stocks. And so I think that's their rationale there. What would you say to that?
No, the rationale is not wrong in the short term. And again, that's why it's been performing well. The problem is sustainability. The policies that these European countries are running, open border immigration, blah, 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 is not good economically. And the results of that are showing up in their data. And again, they're issuing debt as fast as they can issue debt just to try to stay afloat at this point. So again, I think that's going to come back to reflect in slower earnings growth for these companies, which is again, you're going to get these bouts where international emerging markets outperform, and a lot of that has to do with the direction of the dollar. So the dollar's been under a lot of pressure here lately. Money flows coming out of U.S. stocks going into international. I think that shifts at some point, whether that's next week or next month. I don't know, but at some point you're going to see a shift back into a dollar, and then those assets will begin to underperform maybe later this year, maybe going into next year. Because again, don't forget, if we're going into a recession, they're going to be in a recession first.
Okay. All right. And again, we're going to get to your thoughts on recession in
Yeah.
just a moment here. Can you pull the S&P chart back up here again?
Yeah.
Because I don't think we got to the bottom chart, the
Oh
RSI.
yeah. I think
Um,
we did fall short.
no, it's okay. We don't think we talked about the capital flows either.
Yeah,
But I also want to ask you a couple questions about the DMAs. So
yeah, yeah.
finish up the chart here.
Are you not seeing it?
We're seeing it.
Okay, good. So where you want to start?
Why don't we start at capital flows?
Okay, so yeah, so this is just a money flow indicator. Just it just measures volume and prices. So it just kind of tells you is money coming into the markets or coming out of the markets. And
And this used to be that green chart, right? You've just changed its display.
exactly.
Okay.
I'm still playing around with it. I haven't quite refined it just yet, but I'm using two different terms, kind of creating like a sort of like a MACD indicator, like a momentum indicator for money flows. And so the shorter indicator is turned up, crossed above the longer term indicator, which suggests that in the next few days, that bottom indicator is going to pick up as well. So that kind of corresponds with this recent bottom that we've seen. And again, you're pretty deeply kind of oversold levels on money flows. You're down to levels that normally kind of at least form at least a short-term bottom. And again, I'm not talking, again, I want to be really clear. I'm not saying that the markets are getting set up here for a rally off to new highs and you should just be, completely risk on. I think there's a tradable opportunity here because we have so much negative sentiment in the overall market. And again, when people are super negative, very worried about the markets, that's a great setup for the markets to do exactly the opposite of what you think. But again, there's a lot of people, and this is what's been going on over the last week, is there's so many people that are trapped on what we call trapped longs. These are people that were in the market. That 10% decline was very sharp. They never had an opportunity to get out of the market. And so any rally that you get initially is going to get met by sellers like, oh my gosh, it came back a little bit, I'm out. That happens for a couple of weeks. But if this market is in a bottoming process, we will eventually start finding some footing. And you're starting to see stocks like Meta, Google, Nvidia, they're not going down anymore. Right, the sell-off has stopped, and they're starting to find footing. Every time the price comes down a little bit, buyers are stepping in and buying these stocks. So we may be starting to form a short-term bottom. And again, going back to the momentum indicator, we're very close to triggering a buy signal as well, which should give the market some short-term lift, and relative strength has improved over the last week. So we're seeing some relative strength come back into the markets. We're seeing money flows pick up. We're seeing momentum pick up here a bit. Just suggest that we're likely, to see a bit of a rally here. And, getting back to 58, 5,900 would not be anything of great significance. What we need for that is for the White House to shut up for 5 minutes about tariffs. The problem with tariffs is that we talked about this previously. If Trump would have come out January 20th, says we're putting 25% tariffs on everybody, done, starts tomorrow, and then did it, and then left it alone, the markets would have adapted to it. They would say, okay, great, I can factor that in. I can factor in a 25% tariff. I know what that's going to do to earnings. I can estimate what that'll do to corporate profitability. I can factor that in. Okay, here's what the new earnings is going to look like under this tariff situation. And the markets could price for that. His mistake is he's on, he's off. I'm putting tariffs on. Now I'm taking them off. Now I'm putting them on. Now I'm taking them off. Now I'm putting them on. I'm going to pause them until April the 2nd. We're going to have Liberation Day, April the 2nd. And so like the markets were rallying, after the Fed meeting, and then he comes out and says, hey, don't forget Liberation Day, right? And if he would just shut up, the market would have rallied for a couple of more days. And priced in, this idea of the Fed, stopping QT and starting to provide some monetary support for the markets. But it's this on again, off again narrative that makes it impossible to evaluate what earnings are going to be 6 months from now or 12 months from now. But once we get through whatever this cycle is with tariffs, or however they turn out, the market can price that into earnings. We can refactor these things, then markets will heal up and start to move forward.
All right. So two things on that. One, you sort of started by saying, everything else is just noise, the signals, earnings expectations. But it does seem that they're in the short term here, the uncertainty that's being, increased by these daily, kind of reversals is weighing on markets. I mean, it is the noise is a factor here.
Well, no, but you missed my point. So if, recession's coming, right? That's a narrative, right? Because there's no evidence of that. And if there was a recession risk coming up, that would be evident in the data. And then the markets would reprice earnings for that data. The tariffs is a function of earnings. As I said, everything comes back down to earnings and what I can estimate in terms of earnings. Because why do I buy a stock? I buy a stock based on what I expect their earnings to be in the future, and I'm willing to pay X if Y earnings are going to be there. And right, that's how we get to valuation issues.
Right.
So the on again, off again tariffs make it impossible to estimate what earnings are going to be. Because if I have a 25% tariff today, I can estimate what that impact to earnings is.
Yeah.
If you take it off tomorrow, then what does that mean? Right.
Okay. Okay. So we're not in disagreement necessarily,
right.
But you say don't look at the headlines; they don't really matter. All that matters is earnings expectations. But these tariff headlines do affect earnings expectations because it's they just changed the tariff. I got to go put that in my model, right? So it's a bit of back and forth, all right? So that's number one. Which look, I agree with everything you're saying. Which is once we get more clarity on that, the market will adjust and then absorb and get on with things.
Right.
Markets, as we talked about many times, markets just like predictability, right? And when things are more unpredictable, the market has heartburn because it doesn't like things to be unpredictable. The second thing is we've talked about how Trump 2.0 may indeed be very different from Trump 1.0, who was very market's my scorecard. I'm going to do everything we can to keep the market good. I was just listening to a long interview with Treasury Secretary Scott Bessent.
Right.
Which I'm going to talk about in a bit too. It's going to be part of the rant. But Bessent said this, and then I had an interview that just came out the other day with Art Laffer, economist, who was fresh off meeting with Trump in the Oval Office. And Art basically said, look, it's like I'm a one-factor guy. So I come in, I tell the president what I think should be done, and the president either agrees with me or disagrees with me. And he's like, when he doesn't take my advice, he's like, I don't take it personally. He said, I feel confident enough that the president knows exactly why I'm recommending. Like he gets it. He gets my rationale. I just have to understand that he's not only making the decision on the economic vector. And he's like, I'm a one vector guy. I'm just about the economy. He's like, Trump's the president of everything. So there's a lot of other factors that go in with the decisions he makes, right? And there are times, and it seems increasingly, where he's going to say, yeah, I'm going to disappoint Wall Street with this decision because I'm playing a longer game over here, right? And that's something that I think nobody really expected from Trump coming in because he was so pro-market the first time.
Yeah, we talked about that. Is that during his first term, up to this point, he had tweeted about the market like 126 times, and now it's 2 or 3 times.
Yeah, I'll bet you it was way more than 126 times too.
Probably, but yeah, this is a very different Trump. I think he's learned some really valuable lessons. He's focused on kind of what matters. He is focused on the game to fix kind of what's broken in the system. And I think, and he's getting it. Look, his approval ratings certainly at this point justify what he's doing. The by and large, the public agrees with what he's doing. That is until something breaks, right?
Yeah.
And so, then all of a sudden we'll see what that story looks like. But, again, what you and I talked about previously is that the most important thing he could do coming into office is saying, look, I'm going to do these things and it's going to cause some pain, but I'm going to clean up my house first before I come to you. And he's doing a little bit of that. He's getting a lot of pushback, but he's trying to clean up Washington to a large degree, trying to clean up spending, trying to clean up, waste that we all know is there. He's getting a lot of pushback for that, which I don't really understand why people would push back against cleaning up waste. But, that is certainly impacting markets because, again, if I cut deficit spending, if I cut debt, if I reduce immigration flows, if I change, structures within the very factors, and particularly if I lay off a lot of government employees, and government employees have been a very large chunk of the employment roles that we've seen over the last 4 years in particular, that's all going to have an impact on the economy. So as he does these things, the market's having to simply all try to factor this in. Okay, well, what does this mean for employment? What does this mean for earnings? What does this mean for money coming into businesses that were getting money from the government that are now no longer getting money from the government that they were spending within the economy? So
right. And will this trigger a recession? Maybe
exactly. Yeah. And of course, that's where it immediately all goes to. is everybody's worried about the recessionary outcome. And look, the risk of recession is not, we just wrote an article 2 weeks ago saying the risk of recession isn't zero, talking about those very factors. But again, immediately now you've got 40% of economists going, oh, recession's coming.
Right. To your point, it's not zero, but it's not 100% either.
Exactly.
And we'll get to your thing there. Yeah, real quick. And this was a point that Besant made, where it's something like, I might be misremembering this, but I think it was something like 25% of the spending of that comes out of Washington. It goes through firms that are located within, like, I don't know, 50 miles or less of Washington, D.C. Like, it's some ridiculous amount of money that just flows through the capital there. And so to your point, and I know you said it somewhat flippantly about, I don't know why people are pushing back on being more efficient. Well, it's because this entire power structure has been built atop these money flows, and they're going to do everything they can to fight it, right? And look, there's, you can certainly, I think, say, look, they're taking a extremely aggressive approach with the Doge actions right now, and they're breaking a lot of things they might need to patch up later on. I've talked about this, so I think that's by design. And again, Besant has said we had to move this fast, because if we didn't, the lobbyists would be able to get inserted, the lawyers would get inserted, the whole just inertia blob of the Borg of the existing bureaucracy and the power structure that feeds in all this would get enough purchase that we'd spend the rest of our administration just tied up in courts with these guys, right?
No. And you and I are talking two different things. Yeah, the people that you visually see pushing back absolutely agree. There's so much money, and Michael Leibowitz, he lives in DC, he lives in Maryland, right? So he's right there. And we have this conversation all the time about how much money is just concentrated in the Washington, D.C., Maryland area, because it's where all, if you're a lobbyist, where you live in D.C. If you're a political NGO, you live in D.C., because that's where all the money and the power is, all the connections.
Right. If you're a major consulting firm that's getting these incredible, forever contracts, you've got your big office there in DC. Yeah,
exactly. And that's not who I'm talking about. What I'm talking about is when, I talk about this on Twitter as an example. I'll say, hey, look, if, cutting the spending is good because of X, Y, or Z, or doing this is good because of A, B, or C. It's amazing how many people that I get that argue that point
with you. Well, that's where I was going to try to go with this, which is, we're finding that a lot of and first off, look, I don't want to diminish the fact that there's a real human cost to this, right? It's all academic until it's your job or, your neighbor's job, right? But also, we're finding that a lot of funds were going through organizations like USAID and whatnot to the media, and the media was a big beneficiary of some of the spending that's getting cut. So the media is going to be telling a story of why this is an assault on democracy in America and whatnot. So there are a lot of people that are just getting that message. And again, I'm not trying to necessarily say right or wrong. I mean, I am for being prudent and responsible with taxpayer money. Don't get me wrong. I'm not going to say here that Doge is doing everything perfectly, but I think there are people whose media sources are intentionally telling them, hey, this is really bad and you should be agitated about it. Probably less because they truly believe it, and more because it's like they're having an existential crisis because they're losing a revenue stream that they depended on.
Right. Well, and that's the funny part about this, right? Because all we're talking about is getting rid of the waste. And the very people that argue with me about getting rid of the waste are also the ones that are always complaining about the debts and the deficits, and how this is going to be the end of our world as we know it because of the debt and the deficit, and we're all going bankrupt as a country. But yet this is the very process. If you want to fix the debt and the deficit, you got to fix this problem. Yeah. I mean, that's, you got to cut spending and you got to get rid of waste. And, and so it's interesting because, again, this is just, it's a very, a very politically divided argument. But when you step out and pull all the politics away from it as a taxpayer, where do you want your tax dollars going to? Right? Are your tax dollars going to the things that are important to you, or are they not? And if you're supportive of some of these things that your tax dollars are going to, great. I mean, that's all your thing. For me personally, I'm not a big fan of paying school taxes as an example when I don't have kids in public school. But that's just a part of the process of kind of how taxes work. And at the end of the day, if we were more efficient about how we spend our tax dollars, we wouldn't have to pay as much in taxes because you wouldn't need to
Right.
collect as much in revenue. And again, when you're talking about 100 and roughly about 108%, it takes 108% of our tax revenue. So all the money that the government collects in taxes, it takes 108% of that tax revenue just to cover Social Security, Medicaid, Medicare, prescription drug benefits, military, veterans, and interest on the debt. That's all mandatory spending. That gets paid regardless of
Right.
debt ceilings or government shutdowns, whatever. That money goes out the door. It's more than we collect in revenue. Everything else that we do, Department of Education, Department of Energy, Department of Agriculture,
That's
departments
all
of this,
deficit. Yeah.
that's all deficit spending. So if you want to fix the deficit, you got to start cutting spending somewhere.
Yeah. So part of this is human nature, right? Especially Americans and folks, I'm sorry, but I'm just painting with a broad brush. Culturally, we want the easy button, right? We want
Yeah.
the painless situation. We want the pill, so I don't have to change my behavior, right? So a lot of this is just like everybody agrees, yeah, being healthy is much better than being unhealthy. But if it means I got to get off the couch and I got to go, sweat for, an hour every day, you'll lose a lot of the people on that because that's hard, right?
Yeah.
And so, there's part of that going on. And also, I just want to say too, look, I really try my best here to take a nonpartisan issue and talk about what is happening, that relates in politics to the economy without trying to put a political spin on it. And just to support that comment, I've got an interview coming out with David Stockman tomorrow, the day after this video releases, Lance. And he was the head of the Office for Management and Budget under Reagan. He
Great
was
guy.
a U.S. Representative in the House. He was then a big Wall Street guy. So he knows kind of how all the system works. He knows everybody. He's written a ton of books on this stuff. He's a big fan of the mission of Doge, and he doesn't think it's going to be successful.
I don't either.
Yeah.
Because again, you've got too many people that are trying to block it at every turn.
Yeah,
And
and that the cuts that are really needed are way bigger than have been achieved so far. And he just doesn't think there's going to be enough support politically or for the public to cut the muscle and bone that's going to need to be cut to really get this sustainably under control.
right. And again, this goes back to what we were saying is that the things when you're spending more money than you collect just on Social Security and welfare and interest on the debt, that's a problem. And but again, you've got to start cutting at some point. You're going to have to start cutting severe chunks of military spending, those type of things, and nobody wants to do that. And again, all you hear about is that he's going after Social Security and Medicare. No, he's not. Nobody's going after your Social Security and Medicare checks, right? You're still going to get your Social Security, Medicare, Medicaid. You're going to get all that. But to David Seidman's point, he's right. Very smart guy. Is that just the small cuts that are being done? Look how much pushback they're getting. I mean, lawsuits are being filed. All these type of things are going on. There's all these accusations. We've got people running around torching Teslas at the moment because they don't like what Elon Musk is doing. And these are very insignificant cuts. If you take a look at the total amount of money that we spend, when you're talking $6 trillion a year in federal spending, and we're talking a billion here and a couple of billion there. I mean, even if you cut $500 billion, you're still spending $5.5 trillion.
Yeah.
I'm not minimizing the impact of cutting 500 billion, but we're nowhere close to that number.
Yeah. Yeah. Well, look, I'm actually, when we get to the rant, I'm going to try to put a little bit more of a positive spin on this. Yeah, it's look, we'll wish it well. We'll see what happens. But yeah, right now, the umpire is fighting back, right? The rebels made their initial salvo. Now the Death Star is getting put back into to operation here. We'll see what happens. But anyways, fingers crossed. And it's going to give us a lot to talk about. And of course, high level, all of this disruption, not just Doge, but the things that are the new administration's trying to push to create greater economic growth while getting costs under control. Doge. Tariffs, tax cuts, deregulation, et cetera. Right now, there's just a lot of cloud of uncertainty there, and that is going to continue underway on markets for a bit. But we'll see if we get this the short-term bounce that you're looking for, Lance. Okay, so I want to move on because there's a bunch of other things I want to talk about before we wrap up. We had the latest FOMC, Federal Open Markets Committee, from the Federal Reserve release this week. Jerome Powell came out and did his press conference. Basically, they kept the policy rate unchanged. They did announce that they're basically cutting the pace of QT in half, and they're going to be letting a lot fewer U.S. Treasuries roll off the balance sheet. They will keep the mortgage-backed securities rolling off at the same rate because eventually they've said we want to get those off our balance sheet. And of course, it raises the question that people have asked all the time, which is they should have never been in there anyways, but you know, they're slowly trying to slink off.
Yeah, Mike and I just actually had that conversation yesterday, which is, so just to be clear, so two things. One, there's a lot of misnomers about QT. And remember when QT first came out, everybody was like, oh my God, the Fed's selling all these treasuries, so interest rates are going to go off to the moon because the Fed's selling treasuries, and they were never selling treasuries. They were just simply letting bonds mature. They were actually buying bonds a lot of the time along the way because they said, we're going to let 25 billion a month come off our balance sheet.
Which means it just matures. The bond expires, and they decided not to basically buy another one to replace it.
Yeah, but when your balance sheet is 8 trillion, right, at that time, or 9 trillion, where we're close to that, there was a lot of months where maybe 50 billion was maturing. So they were having to come in and buy $25 billion worth of bonds and just let 25 billion mature. Sometimes they might, I have to go back and look at all the weekly data, but there might have been a week where they actually did have to sell some bonds because only 20 billion matured that week versus, and they had to sell an extra 5 billion. But most of it was just rolling maturities. That's all it really was.
Yep.
And so they cut that number. I thought was interesting. They cut it by $20 billion. They went from 25 billion to 5.
Yep.
So that'll help supply some bid to the markets now because they're going to have more than 5 billion a month, or 5 billion a week maturing. So they're going to be now having to buy the difference and buy some bonds. So that's actually good for the bond market. And bond market like that, by the way. We saw that nice rally in bonds following that announcement. But Mike and I had that very same conversation. The only reason mortgage-backed securities are on their balance sheet is because of the financial crisis when they were trying to bail out the banks and the mortgage companies during the financial crisis. They should have stopped right after 2008. Once the housing market stabilized, they should have stopped buying mortgage-backed securities. But they did a little bit more in QE1, did some more in QE2 during the pandemic. When they QE4, they bought some more. So now, to your point, they're going to let that roll off continue. They do want to try to get those mortgage-backed securities off their balance sheet at some point. So most likely, if we ever move back to QE, which we will eventually, and this is that first step towards that direction, that QT and mortgage backs will probably continue, and they'll just ramp up buying U.S. Treasuries.
Yeah. So basically, if QE resumes, it should be a 100% U.S. Treasury QE, not.
Right.
Okay. Also notable too, they reduced their year-end GDP forecast from 2.1% to 1.7%. So the Fed is saying, hey, we're seeing the economy slowing too, folks. They've raised their core PCE forecast from 2.5% to 2.8%, and they raised their year-end unemployment forecast from 4.3 to 4.4. Not massive changes, but just sort of directionally, they're saying, yeah, economy's going to be slower, inflation's going to be a little stickier, and unemployment's going to remain relatively stable, but with a little pressure to the upside.
Right. So I've got an article I'm writing right now about the whole stagflation narrative, because immediately after this came out, Zero Hedge and a bunch of other people came out. I was like, oh, the Fed just admitted to stagflation. No, they didn't. Yes, they increased PCE this year by 0.3 of a point. They reversed it next year. All they're saying is that tariffs could cause a little bit more inflation this year if, and this is the huge if, companies can actually pass that tariff on to consumers. The problem is, and this is where economists always get tariffs wrong, is they forget about consumer choice. When you have 10% of the population driving 50% of purchases, the other 90% are just struggling to get by. So if you raise the costs on whatever it is that the bottom 90% are buying, they're just going to buy something different. They'll buy whatever's American made. They'll buy whatever's cheaper, or they just won't buy it because they can't afford it. Maybe the 10% of the population will absorb some of the tariff, but you can't pass all that tariff on to consumers because of consumer choice. But what the Fed said was, hey, this may cause it. We may see a little bit of an uptick in, in inflation of 2.8. And then immediately all these headlines came out. Oh, stagflation's back. You have slow economic growth and high inflation. First of all, three problems. The definition of stagflation is not low economic growth and high inflation. It is low economic growth, high inflation, and high unemployment. 4.1%, 4.2% unemployment is historically low. That is not high unemployment. Inflation at 2.8% is not high inflation. The average long-term inflationary growth trend going back to 1960 is 3.5% on inflation. So you're not even nowhere near the long-term average, even at 2.8. So when you start talking about high inflation, you've got to be above 5, 6, 7% inflation to be considered high inflation. You need unemployment to be somewhere above 8% unemployment. You need economic growth to be somewhere 1% or below, typically negative, to say you are in stagflation. If we go back throughout the entire slate of history, there were only two periods that lasted about 6 months each of where you could actually meet those definitions of stagflation. One occurred in 1975, one was in 1982. Very brief moments that you had this spat, and immediately the economy reversed and you went back into a recession. So, that's so the bigger driver of what the Fed said yesterday or this past week is, look, tariffs might cause a little bit of an uptick in inflation if it can be passed on consumers. But even if that's done, it's going to go away in the following year. And unemployment is going to remain fairly stable. And long-term economic growth is going to drop to 1.7%, which is well below the long-term growth trend since the turn of the century of 2.2%, and more in line with what our target's been for the last year, which we've been saying 1.8 to 1.6. So they've now split the difference between what we're looking at economically going out over the next 3 years.
Well, it's good to hear they've been reading your work closely and are now attributing it. All right. Well, look, a couple of things. First off, to your point about tariffs, just want to make sure folks understand. So the system, it's a reacting organism, right? So to your point, Lance, we say, okay, product X coming in from the rest of the world used to cost this, now it costs 25% more, right? So you as a consumer basically you got four choices, right? You can just pay it, right? I'm going to buy the same product, just going to be more expensive, right? Now, in theory, that will pinch consumer households a bit, right? So you got to watch for overall consumer spending. Secondly, they might buy an alternate version of the same product, right? Well, you know what? I was buying the foreign version because it was cheaper than the American one, because America has a higher cost of labor. But maybe now the American one is now competitive with that foreign one. I'll just buy the American one, right? So in that case, the consumer still may get pinched, but you've got some domestic benefits as those dollars are staying in the country. Okay, the next thing they could do is they could substitute, right? And this is the classic steak for chicken, right? Okay, well, this product got too expensive, so I'm now going to downshift, and I'm still going to have dinner. I'm just going to have something that's cheaper, right? And then the third one is as Lance was saying, at some point the consumer just say, I'm not going to do it, right? I don't need that to live, and I'm just going to forego it, right? And again, that also has additional consumer spending impact potentially on the economy. So there's all sorts of things that could happen, but it really depends upon how that living organism reacts to these tariffs.
And that's why historically, if we go back to when we ran tariffs in the night from 1915 to 1940-ish, you didn't have a lot of inflation because of consumer choice. You also had other economic events that come along that impact that. So for instance, he may do tariffs and you have a recession. That's going to knock all your inflation out from the tariffs, because again, now you just have a downdraft because of the recession. You just have a downdraft in spending right across the board, and that brings all prices down. So, there's, to your point, there's all this. And a really good example of this. Does your wife have, or my kids are really bad about this. They buy a lot of stuff from Shein. So are you familiar with this? From Shein. Are you familiar with this? Oh,
No, I'm
you
not.
obviously you don't have children.
My kids may. Well, they don't live at home anymore, so they might buy them from their dorm room. But yeah,
So
not a brand I've heard mentioned much in the house. We'll put it that
okay,
way.
so but you're probably familiar with a brand called Forever 21.
Yes, which I
Okay.
know is not forever anymore.
We now know the definition of forever. So I love you forever, Adam. We know how long that
Yeah.
is now. So, uh, but yeah, so Forever 21 is going bankrupt because, and they mentioned this, they said, we lost out to Sheen and Temu, which my daughters and my wife, so we just went on vacation to Beaver Creek in Colorado. And so all the girls wanted dresses so they could wear dresses out to a restaurant one night while we were on vacation. So they all bought the matching same dresses and they bought jewelry and other stuff. So to outfit all three girls with dresses and jewelry and the whole nine yards cost me about $27,
You're
shipping
kidding
included.
me. Wait, it's that cheap? I mean, I know
Yeah,
there
it
it's
is.
like cheap
You can
Chinese
buy
knockoffs of.
you can buy a box load of jewelry from Sheen for like $5. It's amazing. And so the point is, and look, and it's all cheap ass crap, right? I mean, it's it's
It's
all going
like
to turn your
deteriorated
fingers
off of
green.
their necks and wrists by the end of the night, right?
Yeah, exactly. But if it's for a one-time event, right? This was for a one-time, just getting dressed up, going out to dinner one night, and but this is my point about choices, right? Is that the consumer, when they're strapped, if I could still buy jewelry and dresses and shop online and get my fix for my shopping habit, whatever it is, and if I can do it on Sheen or Temu and get stuff super, super cheap, I'll do that. So if you throw a tariff, so let's just say you throw a tariff on top of every Chinese product coming in, you could triple the cost of stuff I'm buying from Sheen, and it would still be cheaper than buying from
Yeah.
Forever 21, right? So again, this is why we have to look at consumer choice. Consumer choice is the most important aspect of your outlook on the economy, because you can't just take in isolation. This is the whole point. You just can't take in isolation, oh, I'm putting a tariff on this, and that's going to cause all these problems in the economy, because you have to understand that the consumer drives 70% of the economy. So their choices matter a whole lot when it comes to your outlook for economic growth, inflation, those type of things.
Okay, and I believe this is an application of the concept of reflexivity,
Correct.
right? Which is that one thing happens, then a lot of other things can happen here, and it's fluid. So you can't just always say, well, if this happens, then this happens.
Right.
The system's
And
going
that
to
and,
react.
and that's the mistake that economists make all the time.
Right. And
They
investors make all the time too, to your
correct.
point.
Yeah. You look at one little isolated point and then you forget about all the millions of variables that can happen based on that point.
Okay. All right. Let's get to your article on the recession risk and why it's not as high as maybe folks are feeling like the media is telling them it is.
Right.
Real quick, folks, I should have mentioned this at the very beginning. But Lance, while you were away on your vacation, we had the Thoughtful Money Spring Online Conference.
Mm-hmm.
And I know it's self-serving of me to say this, but our conferences, I think, are always really good. But this was definitely the best one ever. And I say that empirically based on the feedback that we got from folks. Now, Lacey Hunt kicked it off, keynote. Folks, Lance is going to talk about how it doesn't look like we're going into recession, at least not yet. And I think Lacey would agree with you, Lance, that he's not saying we're going into recession tomorrow. But if you want to hear an extremely well-argued case for why the economy is slowing and likely to slow further from here, and the employment market is likely to deteriorate from here, et cetera, the keynote chart deck that Lacey walked through is a masterclass in that. So anyways, and that's just the first presentation of the, I don't know, 16 we had during the day. It was over 10 and a half hours of material, Lance, which is why I know you're so glad you were on vacation and got to go skiing rather than have to sit through that.
Yeah.
But it really was fantastic. So anyways, folks, if you missed the conference but would like to catch Lacey's part or any other part, you can buy the full replay over at thoughtfulmoney.com/conference. Okay, so Lance, tell us why we're not going into recession, at least not yet.
Well, and look, and I 100% agree with Lacey Hunt, and what he's talking about here is that, look, our conversations for the last year and a half, 2 years, have been that inflation is going to fall because economic growth is going to slow. all the money that you shoved into the economy that created this massive boom of economic growth, which led to the surge in inflation because you shut down the economy, all that was reversing. And so as that money comes out, economic growth is going to return back towards its long-term trend of growth, which has been about 2%. But because you're extracting capital from the markets, all that, nobody's getting checks sent to their households right now. Everybody has to pay their debts again. You don't have a moratorium on rent payments and mortgage payments and student loan debt, all that type of stuff. That reversal is going to lead to a slower rate of economic growth in the future because of the lack of inflows coming in and the increased levels of debt, not just at government levels. That's important as well, because again, we're having to service that debt. That takes away money from productive spending, but also households have taken on a tremendous amount more debt. One of the interesting things that's going on right now is this buy now, pay later. You and I've talked about this before. Walmart just signed a deal, cut their ties with the firm, signed a deal with Klarna, which is about to go public, to do buy now, pay later through Walmart. It's a big contract.
Yeah, sorry to interrupt, but DoorDash just announced the same thing. So you can literally go into Hawk to get a sandwich.
That's my point. That was the point. You stole my thunder.
I'm sorry, dude. Sorry.
But yeah, think about it. You're ordering, you order your McDonald's from DoorDash, or I'm just picking a restaurant. It could be any restaurant, but you're putting your lunch on 4 installments at a 36% interest rate. Why would you do that? Well, that's because you don't have any money to spend, right? You're just trying to make ends meet. That type of debt in the economy, which we have right now and it's growing, is not conducive to stronger rates of economic growth. So, having 4 or 5% rates of economic growth is not going to occur on a nominal basis or a real basis. But what this chart is, I'm showing you right here. Prior to 1977, the National Bureau of Economic Research did not date recessions. That didn't start until 1977. But what's important is that you'll see those yellow triangles. That was the date where the National Bureau of Economic Research said, "Oh, there's a recession." Mm-hmm. It's almost always, in hindsight, the closest they've ever been is a 3-month lag. Generally, it's somewhere between 9 and 12 months before we find out we're in a recession. So, but what's important is that the difference in 2020 was really interesting. By the time that the National Bureau of Economic Research said we had a recession in 2020, you were back to 5% economic growth in the economy. So I'm not sure what good it did you, right? So worrying about onsets of recession, the point here is worrying about the onset of recession, those type of things, we're not going to know for months until after we're well into it. So what we have to do is we need to rely on better, or I should not say better, but more real-time indications of kind of what's happening in the market. So that's why we created, this economic composite index. And this is a composite, and it's a black line. And the reason there's a red line behind, I'll explain. But the black line is the economic composite index, and then the gray shaded area in the background is GDP. And that indicator is 100 data points on the economy, both hard and soft. So you've got soft data, you've got hard data, which you've got surveys, you've got manufacturing data, all that in there. And that's turned back up into positive growth territory. Now, that doesn't mean boomer economic growth. It doesn't mean we're about to take off to the moon here, but it also suggests that the economy is still operating okay, and things are going okay. We just had retail sales. Core retail sales were up 1%, a little bit weaker than expected, but not negative. So consumers still out there doing their job. Now, one thing to understand is this all lagging data, but this economic composite,
is that a real 1% or a nominal 1%?
That was a real.
Okay.
So, but when you look at all this, this is still lagging, but it's lagging by only 30 days. So again, this is why, the Atlanta Fed GDP now, that will show improvement in the next month or two before we get to the end of the quarter. So it's, again, you got to be careful about data that you're bringing in, and we have to understand that we do run on a lag. So, we're trying to push things in a manner to where we can get a better read on what's happening economically. The red line is the best recession indicator out there on the market that's publicly available, and that's leading economic index. And this is the 6-month rate of change in leading economic index. And the economic composite has a very, very high correlation to the leading economic index. Now, both of these indicators were wrong for the first time last year. because they were deeply negative, said we should have a recession. Everything was there for a recession, but accounting for all this money that we put into the system, all the government stimulus, we were able to avoid a recession. At least as we know of right now. We may come back and backdate some later where we find out, oh, maybe there was a recession. We won't know for a while. But so far, this is about the only indication we got to levels that are normally very recessionary. Didn't have a recession, but now those indicators are turning back into positive territory. Now, it's easy to say, well, they were wrong, and so maybe they're wrong now. It's possible. But when you have something with about a 98% accuracy historically, you don't really kind of want to, and especially when you had some anomalies and things that were going on because of all the government spending, et cetera, you don't want to necessarily discount the entire history of that data because of one event where
it would be interesting to see a line on this chart added for fiscal and monetary liquidity or stimulus.
Yeah, and that's something I'm kind of playing around with. So I may have that for you shortly.
Great.
But here's another index. So this is so we talk about ISM, manufacturing and services. And this indicator is actually a really good indicator. This is a composite index of ISM, manufacturing and services. And it's economically weighted. So our economy is about 80% services and about 20% manufacturing. So you take the manufacturing index, you take that number, 20% of that, and 80% of the services index. And while that's been flirting near recessionary territory, it never really got into recessionary territory. And again, when you kind of get, into the 45 range on that index, that's normally where recessions occur. So you can see the dot-com crash, see the financial crisis, see the pandemic. But when you're just kind of flirting with contraction, it's slow economic growth, but it's not recessionary. And right now we're not, where that economically weighted index is still well into expansion territory. That doesn't suggest a recession's on the horizon. It does suggest, though, you're close to 50. That does suggest slower economic growth. Again, just kind of like Lacey Hunt's suggesting. None of this precludes that we could have a recession a year from now, 2 years from now, whatever. It's just saying that right now, the risk of recession is still pretty low. We've got to, again, as always the case, in order to get to a recession, I've got to take positive economic growth and turn it into negative economic growth for 2 quarters. Well, it's not going to go from 2% positive economic growth to negative 1% economic growth in a quarter. It's going to go 2%, 1.5% the next quarter, 1% after that, 0.5% the quarter after that. So now you're a year out. And then finally, you get to a negative reading for 2 quarters. And then you can say, okay, great, we're in a recession. You're going to have plenty of indications that the economy is slowing down dramatically to get to a recessionary territory. And for investors, this is bringing all this. Why is any of this important? Because this all impacts earnings. If we begin to see a real deterioration in the economic data, we will see that reflected in earnings, and the markets will start to reprice for those lower than expected rates of earnings because of slower economic growth. And we don't see that yet. The earnings aren't coming down dramatically yet. So the market is overcorrected for the slower economic data that we have currently based on the reversion or the revisions to the earnings data that we're currently seeing.
Okay. So just making this real for investors, you would say, hey, look, lots of reasons to have concerns that economic growth will be subpar going forward, but there's not really reason to start positioning or creating a trade for imminent recession because we're just not seeing that in the warning signs that you're tracking.
Correct. And again, so this is, and just to show you why this is important, this is GDP on a monthly basis versus the year-over-year change in the S&P 500 earnings per share, right? So the red line is earnings per share. The black line is GDP growth. And you can see there's a very high correlation between the direction and trend of earnings versus the direction and trend of the economy. And right now, the economy, this is nominal GDP, which is what feeds into earnings. The economy is still growing at 5% on a GDP growth basis. So we've still got a long ways to go to get down towards zero where you're going to start really impacting earnings growth. But again, earnings have contracted. The rate of earnings growth has contracted along with the rate of GDP growth since the peak of the pandemic, coming out of the pandemic in 2020. So again, that's why, that's again, from an investment standpoint, all this other stuff, when you read a headline from, somebody or watch a video and they're like, oh, the economy's heading into recession, you better get out of stocks now, or the debt's going to blow up the world, you better get out of stocks now, whatever the headline is, right? The doom and gloom stuff. Just come back to the reality is that, okay, I hear what you're saying. I'm not going to discount that, but how does that impact earnings? Because at the end of the day, it's economics. Where do earnings come from? It comes from economic growth. So as long as there's economic growth, companies are still going to generate earnings because the economy is growing, because people are spending money, 70% of consumption. Where do earnings come from? It's from what consumers spend. So if from an investment standpoint, all you need to look at is where earnings are going, and is there large reductions or increases to earnings expectations, because that's going to drive the rate of change in markets over time.
All right, and just a little preview here. So, folks, I interviewed Wolf Richter the day before I'm interviewing here with Lance. The Wolf interview is going to come out early next week. But Wolf tracks consumer spending. He's famous for his charts of all the things that he tracks. Yep. And basically, we were tackling head on, hey, what's the likelihood of recession here? And Wolf, like Lance, was saying, hey, I've got a lot of the same concerns you all do, but I just am not seeing it in the data. Now, the data is not as strong as it was in the past year or two, but it is not flashing imminent, danger yet. And I pushed him pretty hard on the consumer side, and he had a lot of data to refute some of the holes I was trying to poke in it. So if you want to see a good defense of things are okay enough for now, you're going to get that with Wolf in just a couple of days. I will say, Lance, his concern, which I think you'd probably share, is just valuations. And he's just basically like, look, there's going to be a big corrective event in the markets at some point. And it could be a crash. It could be a 2-year-long grind down. He doesn't know. He has no idea if it's going to start this year or 3 years from now. But he says, that's the thing I worry about. I worry about, and he basically said, I don't think a recession is going to start until there's a big enough market correction to create some wealth effect scares. And then that's going to impact consumer spending.
Yeah, and again, this goes back to what I was saying earlier. Let me see if I can find. Bear with me one quick second, because I posted this on Twitter this morning. Really good. It was a really good Wall Street Journal article about kind of the wealth gap, and we've talked about the share of the market that's owned by the top 10% of everybody, yep, et cetera, and that's a big problem in the economy, is because we have created this divide of wealth over the last 15 years through quantitative easing and all these type of things. It's just exacerbated that holding of wealth is now just migrated up to the top 10%. And so this morning there was a really interesting article. Oh, here it is right here. Share this real fast. So this was the graph that came out of this. This is the share of spending by income group. So the top 10% of earners, that's the bottom, right? They make up for half of all the spending. They also own 90% of the stock market. So to your point, you're going to need a significant enough correction in the stock market to take away enough of their wealth to where they can track their spending, because there's such a big part and parcel of the economy and the spending brackets now.
Right. And to your point earlier, Wolf was like, I get it. I am not a fan of the wealth gap, but he's like, but spending is spending. Like GDP wise, it doesn't matter where it comes from, the top or the bottom, right? So as long as the total spending is staying relatively steady, then economically we're going to be okay. Societally, we might be worse off if more and more of that spending is being done by the top 10%.
Absolutely agree.
But yeah, until that 10% gets spooked enough or injured enough that their spending goes down, it's going to be hard to really move the needle. That's
right. Well, again, look, what the federal look, I'm gonna point directly fingers at the Federal Reserve, because they were the primary culprits. And again, I've said before, is that we should have never bailed out the banks in 2008. You should have let them fail. we would have been so much better off. Yeah, it would have been painful for a couple of years, but we've been way better off today. But they created moral hazard. And moral hazard is the definition of moral hazard is that you are guaranteed or insured against losses. And because of all their actions, we have created this moral hazard in the markets, which have created these valuation issues, which have created this collision of risk taking in the markets. And again, you see, unfortunately, you just see a tremendous amount of young investors, retail investors, millennials, Gen Zs, et cetera, just taking on a tremendous amount of risk in terms of leveraged ETFs, options trading. It's all fun. It's all fine and fun as long as markets are going up. But they have been guaranteed by the Fed. And this is why we pay such close attention that every time the Fed says something, it's like we're just glued to the television. What's he going to say? Right. Because everybody's looking for that insurance against the market decline. We're down 10%, normal correction. And everybody's like, oh my gosh, what's the Fed going to say tomorrow? Are they going to cut more? They're going to stop QT? We need some support here from the Fed. But that's just where we've driven the market. So, again, that's just, it's not a healthy outcome for the markets long term. It's not a healthy outcome for the economy long term, because, and this is why so many people are angry. You get down to that 20 to 40, 40 to 60, 60 to 80% of the economy that are just getting by. That's why they're angry about everything, right? They're angry about housing prices, they're angry about college costs, they're angry about everything because they just simply can't afford anything. They're just struggling.
We've diminished their prospects that they've given up hope, and they're seeing the preferential treatment that the rich get, and they're just like, this is so unfair.
Yeah.
Right. No matter how hard I work, I'm not going to get ahead. And those bastards, no matter how much they screw up, they get bailed out.
Yeah. And you can't blame them. I mean, I don't blame them for the way they feel, right?
No, not at all. And look, this is what I'm saying. Like, Wolf was saying, look, I'm not in favor of this, but the system works, still works, even if with the unfortunate reality that those top folks, as long as their spending's continuing, this thing's going to work, right? And to your point, like, not only are more and more people feeling more and more left behind, and that's corrosive of the social fabric, and eventually bad things happen about it, but the way the system is right now, because of enabling moral hazard and all the distortions that have gone on, deformations, as Stockman would say, more and more of the wealth is hoovering into fewer and fewer pockets of the already rich, right? That has part of what has juiced that has been the increase in asset prices from a valuation perspective, right? This is multiple expansion, right? And what that does is it creates a much less stable market, right? That if you have some interruption in these unnatural acts that are going on, the whole Jenga tower could come down, right? Which will damage everybody, right? But it'll damage the less well off much more because they're going to lose their jobs, right? If I'm a rich guy, yeah, my portfolio might take a hit, but I still can afford my mansion, right? If I'm just some working guy, I lose my job, I can't feed my family, right? And then the rescue comes in. What does the rescue do? It reinflates all the assets and helps all the, bails out all the rich guys, where the guy who lost his job just has to pray he can hang on until the economy recovers enough where he gets potentially hired back if AI hasn't already replaced his job by then, right? So the point is like the system is set up to unfavorably prefer the already advantaged, to disadvantage everybody else, but then it becomes less stable. But even when the instability happens, at least the way it's run right now, again, it's going to run to the favor, run to the advantage of the already wealthy, right? So it's a bad system that, again, unless there are some major reforms, and one can maybe give some kudos to the current administration, at least the lip service it's giving to be more for Main Street going forward than for Wall Street. But unless there's some real major reforms there, this does sort of have a date with destiny, where enough of the dispossessed just say, screw this, it's just not working for me anymore. That's one of the things I worry about long term.
No, absolutely. It's and this is something I'm working on for an article right now. So remind me real quick about McDonald's when we get towards our rant. Okay. So because you were talking about AI, and I had an interesting story from McDonald's in Colorado. So, but real quick, I agree with Wolf that valuations are problematic. They are too high. The deviation from long-term exponential growth trends is at extremes. We are going to have a correction of some magnitude at some moment in time because of some reason. The problem with this, and this is what I always talk to you about, Adam, is that when somebody says, oh, the market's going to crash by 50%, great. When's it going to happen? What's it?
Right.
What's going to cause it? And what do you do about it, right? You got to answer those three questions. What we know is historically is that when you have excess deviations from long-term means, when you have exponential increases from long-term growth trends, when you have high valuations, the outcome ultimately is going to be a reversion in prices at some point due to some catalyst. The problem is always the timing. So the problem for investors, and again, so just real quick, I got this email and he's very distraught. He's lost a lot of money because he's been short the market for quite a while now. And he was convinced the market was going to crash. And so he's been short the market. He's lost about half his money. So now he's trying to figure out what to do next and how to get out of this problem. And this is the problem with headlines. This is why you pay attention to what the markets are going to tell you. Are you going to get out right at the top of the market? No, absolutely not. I'm writing an article on this right now, and I've got a chart that goes back a very long ways, back to 1995. And pretty much you can predict when to get out of markets to a reasonable degree. You're not always going to be out right at the top. You're not going to be in right at the bottom, but you can navigate the markets using some very simple tools, because the markets are going to tell you that there's a problem coming. The markets are going to lead the economics, are going to lead the earnings, are going to lead the sentiment well before the world falls apart. So if you just pay attention to what the market's telling you, you can just turn off all the headlines. You can turn off the media, turn off all the headlines, just pay attention to the markets, and the markets will get you out of the market in time to avoid a crash. Again, it's like driving a car really, really fast, right? As long as the road straights were good, but as long as we're going down that freeway and paying attention to the signs that says, hey, sharp turn ahead, we can slow down before we get there. The problem is that we often try to react because we hear some headlines like, oh, I'm going to sell everything, or I'm going to go short the markets, whatever. And you're not paying attention to what the markets are telling you. And it gets you into a really bad spot really quickly.
I totally agree, and I think we probably beat the horse bloody on don't just trade based on the headlines. Yeah. And I know you know this, Lance, but I mean, this weekly show with you is one of the really important canaries in the coal mine that I rely on to say, hey, this is when it's time to worry enough to take action, right? About some potential big market correction, because I think saying, look, there's going to be some big correction at some point in time, everybody would agree with that. It does come down to the when. And we've talked, ourselves blue in the face about how getting out too early can be extremely damaging, if you then miss, years of upward momentum in the markets. So, I just want to be really clear. This show is a really important indicator for telling us where we are in the threat level.
No, absolutely. And that's my point, though, is that like in his situation, it's not the conversation, right? It's what we hear from the conversation. Mm-hmm. And so, if you interview me and I say, hey, look, valuations are really high, and I think at some point there's going to be a correction. Then somebody says, well, Lance said there's going to be a correction. I'm going to get out now. You've got to take the commentary and apply it to what's going on in the markets, right? You just can't take a headline or you can't take a story and extrapolate that into an immediacy of action. Now, trust me, at some point, something's going to happen in the markets, and I'm going to be on here on the show with Adam saying, hey, we just cut our exposure by 25% in our portfolio because of A, B, or C just happened. Or we just cut our exposure by 50% because of A, B, or C happened. And the market may already be down 5 or 10% by the time we do that. But the market's likely in that position about to go down 15 or 20%.
Right. Hopefully you missed the majority of the downfall. Exactly.
Correct. Yeah. And again, and look, by the time we say, hey, we're putting our portfolios back at full weight, we may be past the bottom, right? But that's all we have to do. It's like, if I could bat 700, be a 70% batter, right? I'd be in the Hall of Fame forever. Right?
Yeah, you'd be at the top of the list.
No. Exactly. I mean, most Hall of Famers are 400 batters, right? That means they get a hit 40% of the time. if we can just get 70% of our calls right, we're going to make money in the markets. And at the end of the day, that's all we need to do.
Yeah, yeah. I do want to note on this again, just back to the conference.
Sure.
So folks take this as an indicator, but Darius Dale, who was very bullish, starting really from pretty much October of 2022 up until the beginning of this year. Last time I interviewed him in January, he said, "Look, I'm a cautious bull now," but he said, "I fully expect to become a raging bear at some point this year." At the conference, he declared that he's now a raging bear. And he explains why, and he shows he's really changed his positioning for all that. But again, this is why it's important to listen to people like this to determine when they make action, right? And Darius has said earlier this year, "I expect to become ragingly bearish, but I'm not yet," right? And now he's making his call. At some point, Lance, you will make your call, more bearish or more bullish, depending upon what you're seeing here. All right, I'm going to go into lightning round here just because we're getting close on time, and I will remember to ask you about McDonald's too. Also, I have a note here too, just to make sure. Hopefully, your daughters didn't buy their dresses on Temu with buy now, pay later, but presumably a lot of people are, right?
Yeah, no, they are. And one thing that I have educated my children very closely with is never have a credit card. Only use a debit card if you have to use that at all. And I prefer them to pay cash if they can, because it makes them more sticky about what they're doing. But it's so funny because they come to me and they're like, "Oh, well, my friend's dad says I have to have a credit card so I can have a credit score." No, that is a complete falsehood that was promoted by the banks to get you to be in debt. So you do not need a credit card to have a credit score.
Well, and there was something I was horrified by when my daughters went to college, is this term that their friends were using, which is, "Oh, well, I put it on daddy's credit."
Yeah.
You heard that? And I was like, "Hey, just to be super clear, my daughter, you do not have a daddy's credit to tap."
That's because daddy doesn't have a credit card, so you can't do that.
Pretty much. I mean, as I talked about, I just use debits. But yeah, I mean, there is this culture out there of, "Oh, hey, I've got this line of credit basically that I can use just for, infinite fun at college." And, I had to tell my daughter, "Look, the world's not going to give you one, so I'm not going to give you one now. Let's have you learn now in life how to pay your way." All right. So, I want to talk about, just to do a bond update in just a second, real quick. We talked earlier that the Magnificent Seven, the high growth tech space, has been taking its licks over this market correction here. One company that's taken a ton of licks, and I think it's not just the general market downtrend, but it's been basically an activist revolt against the company, has been Tesla, right? Yep. Tesla's down, I think, 50% now from its all-time high. It's definitely caught up in this pretty violent activist protest, right, where people are setting Teslas on fire and stuff like that. We don't have enough time to go rant on about whether that's a good thing or a bad thing. My question is just for you as a purely like a Vulcan stock analyst here. Is this one of those, like is it getting into territory where it could be an attractive buy because it's been pushed below its true value because of these short-term, non-market related activist issues?
Yeah. So first of all, let me just be clear. I don't own Tesla. I have a hard time buying Tesla because fundamentally it's a car company, right? And they make cars, and their valuation relative to every other car maker is ridiculously expensive. However, that's the logic side of it, right? However, I also realize that Elon Musk is a freaking genius, and that you should never count him out whatsoever. And with what he's doing with SpaceX and what he's doing with solar panels and the Starlink and everything else, the stuff he creates is, he's the Tony Stark of our time, and it's pretty incredible. And as a personal comment, I would not be opposed to buying Tesla at these levels, because I think you're going to get a vicious rally out of this thing at some point. The long-term outcome of this stock, I have a really difficult time with. It is very expensive. It is very overvalued for the revenues that it generates. And forget whether it's a car company, a tech company, or they're building robots, whatever. It all comes back down to earnings growth at the end of the day and valuations. And that's still expensive even at these levels. But the stock is so beaten up that it is going, and it's up actually pretty nicely today, as a matter of fact. But yeah, I think that this is a stock that could rally 20 or 30%, no problem, in the function of a couple of months. But
Yeah.
again, just from any trading perspective, if you bought it today for a trade, your stop price is $5 below where you bought it, and then you're going to sell it, when this thing runs a bit and gets overbought.
All right. Yeah. And one of the reasons why I bring this up is, there's the famous Rothschild quote about buy when there's blood on the streets. And typically when you get to a blood in the streets moment,
You don't want to buy it.
with that, but sentiment is raging, right? Like
Yeah.
it's a negative sentiment extreme, right? Where people have basically given up on something, right? And obviously, if you have a bad market correction or big recession, whatever, right? You can oftentimes get whole asset classes. Sometimes even the stock market in general,
Yeah.
is at a blood in the streets level. This is just a one company example, but it's something that is not related to the company's performance that is driving a lot of the loss of market share right now. And so again, a pure Vulcan investor, not trying to look at whether this is good or bad, this is an interesting case study into, hey, is this a blood in the streets moment for an asset that may be
I think
fairly valued by the market at a much higher price?
Yeah, and here's what's interesting, right? The sell-off in Tesla started before all this stuff,
Sure.
right? And so this goes back to what we were talking about earlier about trying to assign rationale to why something is happening. And this is the dangerous part about investing. So forget about what's going on with, people lighting Teslas on fire and all that, right? Let's just look at the chart technically and understand why we're going through this correctional process, because that's all that's going on. Back here, the stock was, so back in late 2024, the stock was on a massive tear. The thing had gone from about $220 a share to $400 plus a share, was trading 3 standard deviations above its long-term moving average, extremely overbought on a relative strength basis. Money flows were extremely overbought into the stock. Momentum was extremely elevated. So you had the perfect condition for a sell-off in the stock. So the stock started to sell off here, and it's just getting a little bit of pullback here. So a lot of the speculators were still, it's it sold off a bit, I'm going to buy some more. Retail investors were jumping in, etc. And then as the sell-off started to increase, you broke this kind of primary moving average, and then that was where all of the algorithms started stepping in. So now you converted all of the algorithms that were buying the stock on a technical bid to turn into sellers of the stock. So as the stock started to decline, you started selling more and more of the stock, started scaring people. And then you get into this whole narrative about Doge, and that just applied more pressure to the stock price. And so you got this really massive sell-off in the stock. But all that happened at the end of the day is we just went back to where the stock was trading previously, when it bottomed, and we're sitting right now on a very nice uptrend in the stock. We just formed a higher low. The stock's starting to bottom and turn up. You're about to trigger, kind of important buy signals for the stock. So again, that's what I'm saying is like, you could buy the stock here, just technically buy the stock here. You put a stop in at $220 a share, which is this bottom right here. So if you break this bottom, you're out. Yep. So you buy the stock here, you put a stop in at 220, and you got to honor the stop. So don't email me 6 months from now if the stock takes out 220. It's like, well, Lance, you said buy it, but now it's down to 180, because it could get down there. We are not deeply oversold on this stock on longer term basis. So you put a stop in at 220, you get a rally up to 330, 340, you sell the stock and move on.
Okay. All right. So your general answer to my question is hey, quite potentially, this thing could be something that got pushed lower than natural market forces would have pushed it, and you can ride the rebound. Okay.
Correct.
All right. And again, look, I'm not recommending folks go out and buy Tesla.
No.
And I want to be real clear on record, as it was going through that, well, for the past bunch of years, getting up to that zenith you were talking about, I was railing against its valuation, the crazy amount of naked puts that people were putting on Tesla every day. So I'm not here to be a Tesla champion.
Yeah, but a lot of the sell-off was the unwinding of all that.
Exactly, of that froth. Yeah. But what's interesting is it looked like, and who knows, right? But it looks like it got down into the mid 300s, 340 by the natural market correction, and then who knows how much it would have continued naturally. But a lot of the recent sell-off is at least correlated with the anti-Elon, reaction and the burnings and protests and stuff
Yeah,
like
and
that.
that's again, sentiment plays a big driver in the markets short term, right? In
Right.
the course of a week or a month or 2 months or even a quarter, all that matters is sentiment, right? Valuations don't matter, earnings don't matter, nothing matters in that short of a window. It's all sentiment, either bullish or bearish, right? So if there's something that's going on headline wise, it's spooking investors, you're going to get a sell in the market. If something happens in the markets and everything, the Fed comes out tomorrow and says, hey, we're going to cut rates 4 times this year, this market's going to run off screen, right? So, sentiment is the only thing that drives markets short term. And so, yeah, when you have something going on like right now, all the headlines about Tesla and everything
Yeah.
else, and yet Tim Waltz
Negative
out there.
sentiment's just in the driver's seat, right?
Right.
Exactly. And
Yeah.
look, I live out in Northern California, right? Tesla land, right? And the number of Teslas here that have the bumper stickers that like I bought this before Elon went crazy. Don't
Yeah.
wreck my car. That type of stuff. They're everywhere now. Okay, so bonds. So just to give a quick update, looking at the 10-year yield, since the beginning of the year, it's really kind of been in a steady march down from about 475 to 425, 420.
Yep.
So the momentum is favorable from your point of view. And it looks like the momentum is still to the downside from here. Um, you know, I imagine you're feeling pretty good right now about your bond position.
Well, I mean, look, again, it's not really about feeling good or feeling bad. I mean, we own bond, we have a 60-40
Well,
allocation to
feeling
our,
good that
right?
you've been telling people you were expecting yields to come
Yeah,
down,
yeah.
and it seems as if they are. Yeah.
Right, right. And so yields are tracking economic growth. So as economic growth slows, and interest rates are going to fall with economic growth, and inflation comes down because of economic growth, interest rates are going to fall because those are all correlated with each other, right? It's just interest rates are simply a reflection of economic growth and inflation. So as those come down, so will yields. And then if you get any type of real trouble in the markets, if you're really expecting some type of break in the market that's going to cause if Darius Dale is right, and later this year the markets are down 20 or 30%, yield, bonds are going to scream because it's going to be a risk off trade,
Right.
into safety. But yeah, I mean, you're forming a very nice.
Which, sorry to interrupt, but
Right?
which Lacey actually does think treasuries are going to perform pretty well this year. So it's just
Well, I
FYI.
do too. I wrote an article in December saying I think one of the better performing assets this year will be bonds. So far that's been the case. But that's this goes back to also the importance of having bonds in your portfolio, even when you don't like them, is they provide a hedge against volatility. So it lowers volatility in your portfolio, provides you an income stream. And like I showed you before, I think our bond position, since we bought it 2 years ago, we're down like 1% right now on our bond position, but we've collected 2 years of almost 5% yields. So, your net return is very positive. So again, it's just always important to factor, the allocation into your portfolio. But yeah, no, the bonds are performing great this year. They've really been bailing out the market, the equity side of the portfolio during this downturn. And so our portfolios have only had minimal impacts. Even though we had a 10% decline in the market, our portfolio was down like 3. So, and that was a lot of that was due to bonds.
Good. And that's the role they're supposed to play in a 60-40
That's right.
portfolio. Yeah. Okay, great. Credit spreads. Anything notable to say about them?
Lots of headlines out lately about people getting a really short-term chart of credit spreads. Oh, look at their credit spreads are blowing out. They're not. Get a longer-term chart. You can barely see the uptick. Yes, there's been an uptick because particularly when you look at junk bonds versus treasuries as an example. Junk bonds are very correlated to the markets. There's a very high junk bonds are basically a alternative trade to stocks. So when the stock market declines as sharply as it did, you're going to get an uptick in high yield interest rates because junk bonds are going to sell off with the market. And that's what's happened, but it's very minor. But having said that, there is a small uptick in yield spreads, and we are paying attention to them, but nothing to worry about just yet.
Okay. So basically like, all right, we're hearing a heartbeat, but we're not seeing a lot of movement yet.
Yeah. I told my daughter the other day, I said, you should be a mortician when you grow up. And she's like, why? That's terrible. I was like, yeah, but on your worst day, the worst thing that could happen, you get a heartbeat.
Yeah, that's a great way to say it. Well, real quick, tell us your McDonald's anecdote, and then we'll wrap up with a really quick rant here.
No, you were just kind of mentioning about AI and jobs and employment. And this is something I've been really working on, thinking a lot about and working on. And I've had a lot of conversations with my kids about it as well. But two things that are going on, kind of employment wise, is where slowing down the rate of immigration, both legal and illegal, which is primarily those immigration jobs are focused in leisure, hospitality, restaurants, construction, manufacturing, those type of things. And then also when we look at jobs, we've written some articles about the fallacy of the $15 hour minimum wage, and that your minimum wage is the worth you bring to the table.
Mm-hmm.
And then if you're dependent on a minimum wage job for a living, like a living wage, the problem is you, it's not the minimum wage.
Well, it was never intended to be a living wage.
That's right.
Yeah.
Right. And so, what those jobs are is they're a training ground for our youth. So when I know I did, I'm pretty sure you did, but when we were 16, 17, 18, and we were working part-time jobs or whatever at fast food restaurants, waiting tables, whatever it was, I was a short order cook for a country club starting at 13.
Right.
But because
they're an on-ramp to the career ladder. Yeah.
Well, but it's not just an on-ramp, it teaches you a valuable skill, right? What minimum wage jobs are is they're a testing ground for the employer and for the employee. Mm-hmm. And look, you've never worked before. You don't know you don't know what a job is. So it gives me a cheap way, an introductory way. Hey, Bob, you show up here at work. I'm going to pay you $7.50 an hour, whatever it is. You're going to do this job. Well, you don't show up on time, you mouth off, you don't take direction, you're constantly arguing with other employees, you're right. Causing problems all the time.
You burn the fries. Yeah.
Yeah. And so the employer can say, Bob, I appreciate you, love you, but this just isn't working out. Didn't cost the employer a whole lot. Yep. You leave with a valuable lesson of what not to do on a job.
Yep.
But if you show up, you do a good job, you show up on time. All my kids work fast food jobs. They waited tables, when they turned 16, they're required to get a job. And the whole reason for that was to make sure that they got introduced to an environment where they had to take direction, work with others, learn that skill set of being a good employee. And then from there, it's cakewalk, right? Whatever else you do in life, you've got that kind of basic set. So here's my story about AI. And this is why I think AI is problematic long-term when it comes to the employment market. So we landed in Denver, in Colorado, and got to the airport, and our flight left at 4:15 in the morning. Funny story. Nobody told me that when you set your alarm for 2:00 on Saturday night, for 2 a.m., Sunday morning on Saturday night, that if there's a time change, it resets your alarm. So we almost missed our ride to the airport, which was at 3:30 in the morning.
Oh, geez.
Because of the time change. Whole funny story to that environment, getting 5 people out to a bus. But anyway, we get there. It's like 7:15, 8:15 in the morning. Everybody's hungry because now we've been up since 3:30 in the morning. And so we're leaving the airport. And when you get outside of the Denver airport, I did not know this, by the way, but do you realize that the Denver airport, square mileage wise, is as big as San Francisco? Had no idea.
No, I didn't. I knew it's big, but no, I did not know it was that big.
Yeah, but it's a lot of flat land. Yeah. so you get outside the airport and everybody's hungry. And so the first place we see is this McDonald's, and was like, hey, we'll just pull in there and grab some breakfast real quick, get everybody fed, we'll get on our way. So pull up, new McDonald's. We walk in, there is literally nobody in McDonald's. Nobody. There's no customers, first of all, but there's nobody standing around, right? There's just all these kiosks. And so you go up to the kiosk, you place your order, and then all the tables have charging stations that you can put your phone on, charge your phone, plug in, all this. So that's how attached we are to social media. That's another warning sign. And so about 5 minutes later, this person walks out from the back and says, here's your food. And, you go get your food. It was like 2 people in the whole restaurant running this thing. And and so when I left there, I started thinking about this. I was like, how many jobs is this going to displace from our youth coming up that need these jobs to learn the basics of working in a society, right?
Yeah. So, I mean, we've talked about this a lot, so I won't get, I'll try not to get on my soapbox here, but I just don't see how AI isn't a massive jobs killer, especially in the near term. Yeah, at some point in time, there'll be lots of jobs, learning how to program the robots and repair the robots and stuff like that. but it's going to take a long time, to train people to get to that stage. And also, are there really going to be that many, right? I mean, we're talking
Well,
about.
the other side is what happens when the AI starts training the AI,
Well,
and
exactly. Yeah.
you know, I don't
Yeah.
need AI. I don't need a programmer. I can just ask AI to build me a program,
Well, and I'll
right?
tell you, there's nothing as addictive to a corporate employer than getting relief from the number of humans you need to employ. Oh my
Yep.
gosh, I don't have to pay salaries. I don't have to pay benefits. I don't have any HR nightmares. I don't have any potential lawsuits, right? So, it's funny, Darius, Dale and I were talking during his time at the conference, and uh, he was sort of projecting a big arc out there, and there was a recession in there at some point, and we come out of it. The sun always comes up after a recession. And I asked him, hey, what does employment look like in a future of AI? And he kind of took a deep breath and just said, he said, that's my biggest worry. He's like, I do think the next big recession we go through, there's a good chance a lot of those jobs may never come back. And I've talked about how Keynes, the famous Keynes, the economist, he talked about this concept called technological displacement, where he said, look, if technology can replace human labor, it should. If it can do it more effectively and efficiently, it should. What you got to do is you got to manage its rollout. If you displace the labor at a faster rate than you can repurpose it to other productive use, you end up creating a social crisis, the cost of which may actually be bigger than the gains that you make from the technology. And I do think we're potentially sleepwalking into that problem right now, where we displace these jobs at such a fast rate that, to your point, Lance, our young workers don't have this proving ground to learn how to become a good worker. The entry level jobs to get on the career ladder are no longer there, right? And how do you? It's not like you're going to leapfrog from no work experience to a middle management position, right?
That's right.
So it's a big real issue, and personally, I don't see enough discussion about how we're going to proactively try to avoid this going forward. It just very much seems like, well, we'll just see what happens, right?
Yep.
And I think the only headline that is more predictable than, hey, we moved too fast on this, is oh my gosh, nobody could have seen, who could have expected these buy now, pay later losses? I
Yeah.
think that's the number one most predictable headline, but a
No.
close second is, wow, maybe we did this AI jobs displacement too fast.
Yeah. Well, and it's funny because I remember growing up. I was a child of the late '60s, and and so I saw my first computer was a Commodore 64, and then the Tandy 1000, from
Mhm.
Radio Shack, and back then you just had the 5 1/4 inch floppy drive, and my neighbor down the street, his dad was the rich guy on the street, and he bought his son a 10 MB hard drive, and everybody's like, who the hell needs that much storage, right? and but so I've been through these whole iterations of computers. But I remember my dad coming home, and he was a purchasing manager for a chemical company, and he's like, someday I'm going to be out of a job because of computers. And it took about 20 years, but he lost his job because they automated the whole system, and they didn't need that anymore. And the speed at which this job displacement will come now will be so much faster. And the thing that we need to be focusing on is that we're not just talking about jobs in fast food and leisure and hospitality or whatever. We're talking about lawyers,
Right.
accountants,
Okay.
financial advisors. I mean, this is why we're creating a whole AI platform on SimpleVisor, because that eventually you won't need me anymore. AI will do all that work for you, and probably do it better at some point than what a human can do. And then you have to ask your question, well, then what are the humans going to do? And again, the people supporting all this, they go, well, they'll just learn to program. Well, you only need so many programmers. Literally, when I want to build something new on SimpleVisor, which is all code, right? I can go into Chat GPT and I say, in Angular, write me a program that does this, and it prints it out. And then I copy it and I paste it and I send it to my programmer, and then he tweaks it.
That's amazing. Yeah.
Right. But
And that's now. Imagine what it's going to be like in a year.
That's right now what you can do with this. It's crazy, but it does worry me about the future for my children what their job prospects look like. That's why I'm really, my son, he's complaining right now because I'm pushing him into computer engineering and he's having to do his programming classes, and, we have lots of conversations, but, it's just, there are just certain jobs that are going to go away in the future if you're not prepared for, what's going to come.
Yeah, no, it's a big issue, and I wrestle with the same thing with my kids, and my kids are less STEMmy. They're more on the human interaction side of things, and maybe that'll be good. Maybe that'll be one of the things that
Yep.
AI gets to last, but I don't know. So it's a real challenge here, and the people who I hear who are real champions of this, who say they're thinking of these social issues, they generally come down to two things. They say, well, we'll have universal basic income. You won't have to work, right? And you and I have, ranted about, we think, the false promise of UBI and stuff like that. And then they say, and people will have time for leisure and self-improvement, right? And I'm just like, you kidding me? We gave them the world's knowledge here, and what do people do? They watch porn and cat videos, right?
The guy that did OpenAI, he did that UBI test in Texas and Michigan. I forget what the other state was. And he ran a UBI test for 3 years. And when the results of the test came back from all this, they found out that people didn't use the time to get more educated. They didn't go do more things with their life, right? They had this money coming in. They simply sat around the house and wasted it.
Yeah. You sap their initiative and really their sense of purpose, right?
Yeah.
So, all right. Well, look, I'm going to end on that very negative note.
That's a whole rant for a whole show one day.
Well, yeah. And look, I was going to end on a positive note, but we've got no time for that positive rant, so we'll have to use it for next time. But anyways, Lance, great as usual. I haven't asked you yet. Sorry, trades.
So the only thing we did this week, so over the last couple of weeks, I'm sure Mike told you this last week, is that we've been buying on this dip. We've been adding to our positions like in NVIDIA, Microsoft, Apple, those type of things, because they're deeply oversold here. They had fallen below their target weight. So we kind of use this sell off in the market to bring them back up to target weight, lower our cost basis, et cetera. Yesterday, so the end of the quarter is coming, and in the dividend equity growth model, we rebalance that one once a quarter as part of its process. So our portfolios, you have to understand, is that portfolios have different processes for the type of portfolio that it is and for the purpose. And this is the one thing that is very important to understand about when you're building your own portfolio. You have to really understand what is your goal, what is your objective, and then make sure that your portfolio is designed to meet that goal and objective, and then have a policy that runs that portfolio. So if you can't sit down and write on a piece of paper, this is your exercise for this weekend after you finish watching the show. Sit down at a desk and write on a piece of paper the 10 rules that guide your portfolio: how you buy, how you sell, when do you rebalance, those type of things. If you can't do that, you should immediately stop managing your money and go hire somebody to do it for you, because that's the very basic premise of managing money. And if you don't have a set of rules to follow, you're just kind of throwing darts at stuff, and that's not going to work out well. So every portfolio we have has a investment policy statement tied to it for when we buy, when we sell, how we do things. Well, the dividend equity growth model is to provide relative equity performance to the S&P 500 while providing a dividend yield at least twice, trying to get to at least twice that of the S&P. So you get a higher income yield as well as growth from the portfolio over time. And so part of that process is to rebalance it once a quarter. Well, we're not to the end of the quarter, but this decline in the market gave us a really good opportunity because it's split between value and growth. Value's been way outperforming. Growth has been taking a hit. So we did this rebalance that allow us to buy a lot of those growth stocks really cheap at near bottoms, and then took profits in our value stocks, which have been really outperforming as of late. So we did that this week. There's about 15 trades altogether. No, sorry, there was 19 trades altogether. 16 of those were basically selling value, and then about 6 of them were buying growth.
Got it. So rebalancing your existing holdings between value and growth, selling value, buying growth.
And
Okay.
just and all we were doing is moving back to target. So for
Yep.
instance, if the value stocks are 3.33% of the portfolio, a lot of those were at 4.5. So trim those back to 3.33. The growth side, there's 6 growth stocks in the portfolio to give you relative market performance because of ETF participation. Those 6 stocks were at like 4% weight. They should be 5. So they were just moved back up to 5.
Okay. All right. And folks, when Lance and I talk about position sizing, which is one of the many, just practices of Lance's portfolio management, you like to call it gardening.
Yeah.
This is what we're talking about: is keeping things at their target weights, returning things to their target weights.
Just real quick, if you
Yeah.
don't understand the importance of target weighting your portfolio, go read the book Turtle Trader by Michael Koval.
Great recommendation. Okay, well, look, and wrapping up here, folks, if you feel like the best way to rebalance your approach to investing and just your overall happiness in life in general is to watch Lance on these weekly sessions here on Thoughtful Money, please let him know that by hitting the like button and clicking on the subscribe button below, as well as that little bell icon right next to it. If you failed Lance's investment policy statement test, if you couldn't write something really clear and want to take his advice of getting help, getting somebody, a professional to manage your portfolio for you, if you don't already have a good one who's doing that, consider scheduling a free consultation with one of the financial advisory firms that Thoughtful Money endorses, perhaps even Lance himself and his team there at RIA. To do that, just go to thoughtfulmoney.com, fill out the short form there, and the firms will be in touch with you right away. All right, last two, folks, if you haven't watched or if you didn't watch the conference over the weekend, but think it might be a good investment of your time now, just go to thoughtfulmoney.com/conference, buy the replay videos there. All right, Lance, it's been great another week. We went a lot longer than I thought. Sorry about that, folks, but I think it was all good material.
I missed a whole week. I had to play catch up.
Yeah, I guess so. Exactly. Well, anyways, we're glad you're back, Lance. So good to have you back in the driver's seat.
Perfect.
All right, everybody else, thanks so much for watching.